If you're looking for the simplest way to invest in the stock market, you'll want to learn about index funds. Let's go over what they are, why they're so popular, and where to find them. An index fund is a type of investment that tracks a market index, which is a collection of companies grouped around a certain theme. Some well-known examples are the S&P 500, which includes 500 large companies in the United States, or the Nasdaq, which is focused on the technology sector. You can't invest in indexes directly, but you can buy index funds, which aim to closely replicate a particular index. There are four main benefits that make index investing so attractive: diversification, simplicity, automatic rebalancing, and low cost. Let's look at each of these. When you invest in an index fund, it's like buying a piece of every company that's included in the fund. This means you can get exposure to hundreds or thousands of companies at once, so it's an excellent way to diversify your portfolio, and that means you're reducing risk. Unlike with individual stocks, you don't have to spend hours researching companies, keeping up with the latest news, or trying to predict what a company's stock is going to do. All you have to do is invest your money and then leave it there for the long term. When you pick your own stocks, you'll find that some companies do better than others, leaving you unevenly weighted towards those companies over time. But an unbalanced portfolio means more risk. For this reason, you should rebalance your portfolio at least once a year so you're not overexposed to any individual company. With an index fund, though, you don't need to do any of that. It's the job of the people running the fund. You can just sleep well knowing that any necessary rebalancing of your investments will be taken care of automatically. Index funds are also managed passively, which means there are no active decisions to be made by a fund manager. They just passively track an index. This means they have much lower fees than an actively managed fund as well. There is still a small annual percentage fee to cover the costs of running the fund, but it's minimal compared to what you would pay for most actively managed funds. Alright, so now you know the benefits. There are a couple of different types of index fund you should be aware of. Mutual funds or exchange-traded funds, also commonly called ETFs. Both can be index funds, but they work slightly differently. Index mutual funds are bought and sold at the end of each trading day at something called the net asset value. This means it makes no difference what time you buy or sell on a particular day. All trades for that day execute at the same price. ETFs, on the other hand, are traded on stock exchanges like individual stocks. This means they can be bought and sold at different prices throughout the day as the market price fluctuates. For most long-term investors, it doesn't make much difference which type you go for. If there are two funds which track the right index, are both available through your broker and are otherwise similar, but one's a mutual fund and the other is an ETF, you can normally just go with whichever has the lower fee. As an example, if we look at this Vanguard ESG Emerging Markets All Cap Index Fund, we can see that it tracks the FTSE Emerging All Cap Choice Index, and it has an ongoing charge of 0.25%. And that's an index fund. But if we compare it with the ESG Emerging Markets All Cap ETF, you can see that it actually tracks the same index, but the ETF has a lower ongoing charge of just 0.24%. So it's worth checking in case your broker offers both, but one is a better price. So if both ETFs and mutual funds can be index trackers, how do you tell an index fund from an actively managed fund? It's going to vary slightly by broker, but if we look at Vanguard again, just because it's a really popular one, if you look at all of the funds together, it actually has a way that you can filter by active or index fund. So if we select index fund, then that's going to filter the list to just index funds. But let's just pick one at random and show how you can see it on the fund details page as well. So if you're just looking at the details, you can see in the information in the sidebar that the strategy is index. If we compare this with this global equity fund, which is an actively managed fund, we can see that instead the strategy is active. Obviously, the layout's going to be different depending on the broker, but you should be able to see somewhere in the fund information by looking for the words index or passive. And another way to tell is that actively managed funds typically have much higher charges. So you can see that this example we're looking at has a 0.48% charge, which is double some of the similar funds which are passively managed. So if you're looking for the easiest way to invest in the stock market with a diversified portfolio, index funds are one of the best ways to do that. If you're in the UK like me, this video on single fund portfolios explains how you can get a diversified low-cost portfolio and invest in thousands of companies around the world, all by buying just one index fund.